Hi there, welcome to Grain TV. I'm Kevin McNew. It's Friday, December 2nd, and a mixed day in the market. So let's take a look at GrainEdge's trading platform and see where we closed. In Chicago, corn pushing a little bit higher, gaining 4.5 cents to 347 and a quarter. Beans in Chicago off a little, closing below 1030 at 1027, and wheat gaining a nice 8.25 cents, although really suffering big losses for most of the week. So most of today was really just sort of consolidation and some reversal from the majority of the week's trend, especially in corn and wheat, where we were lower for much of the week and closed the week on a positive note, but most of that was really just position squaring ahead of the weekend. And this weekend, or going into the weekend, we will digest the CFTC Commitment of Traders report expected out later on Friday. That report is expected to show more short positions in funds for corn and wheat and more longs in beans. So we'll see what those numbers say late Friday afternoon and how we may end up trading Sunday night when we come back. Other news today was pretty limited. There was some discussion that the South Koreans were in the market for a large 276,000 metric ton corn deal in light of the big sell-off. But overall, there was no real other major news to drive the market. There is some lingering concern about dryness in Argentina, but it's still really early there, and the weather models seem to point to pretty good chances of rain for much of Brazil and Argentina, not only in the next week, but also in the longer term 16 to 30 day forecast. So as their growing season takes full effect, the models are suggesting that rain will be fairly sufficient to cover the crops in those areas, but there's still a lot of growing season left. As you start to think about your own marketing situation, we've had a big run up here in bean prices, although obviously it's backed off this week. But when you look for 2017 beans versus corn, I think a lot of farmers are starting to do the math. Beans have really ratcheted up relative to corn here, and I think in conjunction with the rally in crude oil, your input costs are likely going to be higher in corn. So I think it's really, time to start thinking seriously about what your price potential is for 2017. And, obviously there's been a lot of talk by market analysts about the big switch potentially coming for bean acres in 2017. So I would hope that farmers have taken a look at those prices, maybe even thinking about locking them in, because if we do see 4 to 5 million acres more in beans in 2017, and we have a good South American crop in February and March, that could really spell problems for the coming bean market going forward. The other thing to think about is, I think farmers have been selling pretty actively in the last few months the soybeans because of the big profitability, much better than expected yields. Prices have been rising, so farmers have been quick to move beans and hold corn, and I think that probably too needs to change as farmers get into January and February, start talking to their bankers, start looking at their own bottom line. They've been waiting for that corn rally to happen. It hasn't really happened in any sort of meaningful way. That could spell problems as well for the corn market, where we have a big overhang of 2.4 billion bushels of carryout projection. Looking at the cash market, there's some strength going on in cash basis across the country. This week, on average, corn basis was up 3 cents a bushel. We see bigger swings more in the western corn belt, especially in the northern part of the corn belt, where they are wrapped up corn harvest. They're starting to come off of those harvest lows, and we're seeing nickel to 10-cent improvements in some areas as a result. We talked about the western part of the corn belt in Nebraska being very strong for some crush facilities there, for some processing facilities. Take advantage of these basis levels as they're ratcheting up. Again, I would be hesitant to wait too long into January and February, when I think there might be more pressure from added farmer sales because of cash constraints and getting ready for 2017. In beans, we saw a 2-cent advance on average. Really, the strength was tied to river markets. We saw really good strength in the river markets, where nickel improvement was fairly common along especially the Illinois and lower Mississippi rivers. Let's take a look at what's been going on, and we haven't talked much about wheat here because we've had such limited action, but we really took a big slide. And if we look at sort of a very long-term chart here in Chicago wheat, going back to the highs in October of 2012, when the wheat market was around $9.50, $9.60 a bushel, obviously it's been nothing but a downhill slide since then. And you can see, with the front month December expiring futures contract trading down into that 360 range. It traded as low as 370, but it has an outside chance of getting down to the previous low set back in September at 360. That spells problems. And if we're going to retest that, the market in wheat right now is really starting to shift to the southern hemisphere, where Argentina farmers are actively harvesting, they're actively selling because they've had their export taxes removed, they've had a bumper crop. Argentinian wheat is priced very competitive in the world market, about $10 a metric ton, with higher protein than U.S. soft red winter wheat. Likewise, you've got Australia with probably north of a 30 million metric ton crop coming off the combines right now versus USDA's expectation of 24. So I think there's a lot of problems we have in wheat right now. Looking ahead to January, that's when the USDA will put together their planting intentions report for winter wheat. That may show a big drop in plantings from U.S. farmers, but even so, there are ample supplies carrying us forward. When we look at the price action in March wheat and any of these wheats in particular, what we've seen really as we've gotten to expiration of a contract, whether it was the July contract back at the end of June or the September contract back at the end of August, and now the December contract here, we have seen this sort of stair step, this cash to futures convergence going on. Basis levels, especially in Kansas City wheat, have been exceptionally weak, and the market has really converged with futures dropping to catch up to the cash market in each of these three expirations. And then from that point on, we've sort of been flatlined in a range. I don't see that changing going forward into March, that we are continuing to sort of trade flat after we sort of spike down. So we may have some more downside here, but after that, I wouldn't expect anything more than sort of sideways action unless something dramatically happens in that January planting report. That's all we've got for this week on Grain TV. As always, if you'd like to learn more about how we can help you at Grain Hedge, whether it's cash bids from our 4,500 different markets we're collecting every day, our tech alerts, and our trading platform with streaming real-time quotes, by all means, visit us online at grainhedge.com and take a free demo of our trading platform. Have a great weekend. We'll see you on Monday.